talk, first of all, Bill, to you about the global state of macro right now and just what it means for the Fed, central banks writ large, and interest rate policy?
Well, Dom, I don't think there's any debate at all that the Fed is going to be easing. The real debate is how fast is it going to ease and when is it going to start the next phase of easing? And the December uncertainty is there because the more hawkish members of the FOMC are clinging to the notion that, well, we don't have a lot of data right now that tells us where this economy has evolved. We are certainly concerned about inflation because it's still hanging out at this level that is still above our 2% target. But I think that every member of the FOMC would agree that the neutral rate is below where we are today. And every member of the FOMC wants to get there. The question is how quickly and when do we start? And I think that's the real debate. And if I were to weigh in a little bit on the AI notion, what you showed before, those two charts of Google and Nvidia really highlight the fact that the markets are looking around for where the visibility on cash flow is going to be. With Google, it looks like people are deciding that with the introduction of the new model that they have, the Gemini 3, the visibility of cash flow is much clearer now, whereas Nvidia is subject to the infrastructure trade, which is under question right now. So I think all in all, my vote would be the markets are more concerned about the AI trade than the Fed. If you believe me that everyone agrees we're going to be easing, the question is when.
Bill, you mentioned before that many members of the Fed, probably the economic world writ large, believe that the neutral rate is below where we are now. My question to you is, what does the economic backdrop look like in 2026 vis-a-vis this kind of AI trade and everything else? Do you feel as though that we need to cut rates in order for us to have an economic backdrop that is supportive of some of these valuations?
I think there's no question that the rates are too high relative to where the economy is going and where the economy is. Because even though we are talking about where the estimates of growth for Atlanta Fed would be above 4%, most of that is skewed toward capital spending. And again, that a lot of that is from the AI infrastructure trade, but the rest of the economy is not so strong. Most of the stock market wealth, remember, is owned by the top 10%. 90% of the stock market wealth is owned by the top 10% of the population. People well over $100,000 income. Those who are in the bottom half of the income distribution, many of them are paycheck to paycheck, and I think we are seeing the employment slowdown and the announcements of more layoffs and certainly more M&A in the high wage industries. We're not getting a very strong kind of foundation to maintain the growth, especially broadening out beyond the tech sector. So I think the FOMC members are very much concerned about the state of the labor market, the fact that the employment is stalling out, and what evidence we have of employment growth is in the low-wage service sectors like healthcare and retail. So I think there's a very good case to be made that rates should be cut, and they should be cut quickly because the lag to monetary policy is about a year to year and a half.
And Bill, really quickly, if you could, just tell us what you think. That's the Fed front. Is there anything that you see on the horizon from the executive branch, from Congress, from the fiscal side of things that makes you feel either better or worse about the prospects for 2026?
Well, I hope President Trump can carry out his agenda of shrinking the size of government, lowering taxes, and getting rid of regulations. But I don't have a lot of hope that Congress is going to get much beyond more of the stalling that it's been doing. So the deficit is as bad as it has always ever been. And the only hope that we have for some kind of closing of the fiscal deficit would be from tariff revenues. And that is in question right now.